And so I think right now what you see in the economy is lots of distortion of numbers, lots of distortion of metrics. Right? The fact that we have a debate over whether we are in a recession or not is kind of laughable, right? Because we've been in a recession for 24 months. If you were measuring the production of goods and services, all you got to do is look at the variety of things that were available to you in January of 2020 versus the variety of things available to you today and the delays. If you've got 1/10 the selection and it takes 3 times as long to get it and it costs 20% more, how are you not in a recession? If you look at the US dollar, the supply of dollars has been increasing 7% a year for 90 years. It's been increasing 15 to 20% a year for the past 2 years.
Whoa.
The gold supply increases at 2% a year, 2 to 3% a year. So if you're on the gold standard, that means that the supply of money would be increasing at 2% a year, or otherwise doubling every 35 years. So money under the gold standard, perfectly executed, bleeds energy every 35 years. It's got a half-life of 35 years. But that creates stable prices, Tom, because the economy grows at 2 to 3% a year. So if the economy grows 3% a year, if the money loses 3% of its value a year, then everything kind of stays stable, right? The demand increases, the supply increases, right? That's a good situation. In that case, you can save your money, and 30 years from now, your money will be worth as much as it is today. Now, if it turns out that you're saving your money and the supply of money is increasing at 7% a year, then the money is cut in half every 10 years, right? And so that means in 30 years, the amount of money you have will be cut in half once, twice, 3 times. So you would have 12.5% of your wealth in 30 years.
Michael Saylor's analysis offers a sobering look at the current state of the global economy. His critique of fiat currencies and monetary policy exposes the vulnerabilities that many people may not be aware of, particularly the hidden inflation that erodes wealth over time. As governments continue to manipulate economic metrics and expand the money supply, the value of fiat currencies will likely continue to decline for those looking to preserve their wealth. Saylor's insights suggest that traditional saving strategies may no longer be sufficient, and alternative investments, including Bitcoin, could offer a more secure store of value in the long run. His message serves as a wake-up call to reevaluate how we understand money, inflation, and economic stability in an increasingly uncertain world. Please take a little time to like this video, subscribe to the channel, and turn on post notifications for more videos like this. You can also check out our other videos on cryptocurrencies and the overall digital asset space and drop your comments and observations in the comments section below. Everything you do helps with the YouTube algorithm and immensely contributes to the channel's growth. Thanks and enjoy the video.
GDP measured in nominal terms is a gross distortion, and then CPI is a gross distortion. If I have 100 things that you want, and I pick 10 of them, and I measure the increase in the price of 10, and I ignore the price in the other 90, I can show you a CPI is 8%, right? 8.3% is the number this morning. But the actual inflation rate is higher, but it's inflation on something, like it's inflation on something you want, but I'm not going to choose to measure. For example, the 30-year bond is traded up to 350 basis points, and it was 180. Right? Mortgages have doubled. So mortgages have doubled, housing prices are up 35. And that means in theory, the cost for you to actually buy a home is going to be 50, 60% higher year over year. But I don't choose to measure it because we don't actually calculate CPI that way. I take a survey and I ask you whether or not you think you could raise your rent by something. And if the owner equivalent rent is up 3%, and I say that the inflation is 3 or 5. So we have a set of metrics that are just manufactured metrics, and then we focus on them, and then we talk about them. But ultimately, what you have is an economy that's distorted. There are some things we produce more of, and there are some things we produce less of. And we have flexibility with what we choose to measure. The monetary intervention is the government basically, if I put everybody under home arrest for a year, it's going to be a problem for the economy, right? I mean, if I shut down, they did it in New Zealand, they did it in Australia, they did it in Canada, they kind of did it in certain states in the US. If I do that, that cripples the economy. So while I'm doing that, then if I go ahead and I pump a lot of money in the system, right, then maybe I create a wealth effect and I can say, well, we're recovering. But ultimately, you never recover from the fact that nobody went to school for a year and nobody, went to work for a year, right? You can't, you've lost that forever. You're just not measuring it. You can change your metrics, right? There's a saying, you write the winners write the history books. So the Romans remember the Carthaginians as being like evil, right? If we win the war, then we write out all of the good that our adversary did, and we write up all the good that we did, and we suppress all the bad that we did because we won the war. We write the history books, and so I think right now what you see in the economy is lots of distortion of numbers, lots of distortion of metrics. Right, the fact that we have a debate over whether we are in a recession or not is kind of laughable, right? Because we've been in a recession for 24 months. If you were measuring the production of goods and services, all you got to do is look at the variety of things that were available to you in January of 2020 versus the variety of things available to you today and the delays. If you've got 1/10 the selection and it takes 3 times as long to get it and it costs 20% more, how are you not in a recession? The challenge with money is the fiat currencies that are used commonly as money, they're all broken. They all have a big hole in them. And
the big hole is inflation, period, end of story, or is there something else?
The hole is, we could call it inflation, but inflation is such a charged term because most people think inflation is CPI. The defect in fiat currencies is monetary inflation. It's the expansion in the money supply, not just the increase in consumer goods, because the CPI is it's a sub-metric, right? If you look at the US dollar, the supply of dollars has been increasing 7% a year for 90 years. It's been increasing 15 to 20% a year for the past 2 years.
Whoa.
Right? Right. So the big idea. I
think that's true. So it seems worth walk us through where do you get that number?
Well, if you go back to 1930, my house in Miami Beach cost $100,000. And if you roll the clock forward to 2012, it cost $14 million. And today it would cost you $40 million. So it's 400 times more expensive than it was, 92 years ago. Now, if you back solve that, you'll find that works out to about a 6% or 7% annualized inflation rate, right? And if you go and you look at any kind of scarce, desirable asset, something that is you can't make any more of, you'll find typically they increase in cost about 7% a year normally. You can actually see, if you look at the market basket of things people want, like really good healthcare, really good education, a beach house in the Hamptons, artwork, Picasso's, right? That kind of stuff. That doesn't go up in price 1 or 2% a year. That goes up in price normally about 7% a year. And if you look at the price of a basket of stocks, like the S&P, the S&P has gone up about 10% a year. Well, the reason it's gone up 10% a year is because the money supply expanded at 7% a year, and then the underlying companies probably grew 2 or 3%, effectively. So You can figure this out for yourself if you just start to go and take samples of what stuff cost in 1971, what it cost in 1930, what it cost in the year 1950. And what you'll see is that for anything that's really desirable, like scarce energy that has energy content, it doesn't go up in price 2%. Now, the stuff that doesn't go up in price as expensive is stuff that's highly manufactured with low energy content, high information content.
Saylor further illustrates his point by comparing the price increases of essential goods and services with those of manufactured products with low energy content. While the cost of highly manufactured goods, like streaming services or processed foods, has remained low or even decreased, the prices of energy-intensive and scarce resources, like beachfront property or quality education, have skyrocketed. This divergence, Saylor argues, is a clear indication of the true impact of money supply expansion on the economy.
So, for example, a streaming video on YouTube, or something that could be stamped out in quantity 100 million at a time, boxed food, right? Stuff, highly manufactured stuff that has machines generating it, or even better, something that's got cheaper, right? It costs a lot of money to listen to Beethoven's Fifth Symphony if the orchestra plays it in 1850, but it costs not that much to listen to Beethoven's Fifth Symphony if you're listening on your iPhone through your AirPods, right? So if I can strip the matter and the energy out of the product, I can provide that to you very cheaply. So the information content products got cheap, but steaks, right? More expensive, although there's a slight benefit. If you can manufacture 100,000 cows and I can use machines, right, then that's a deflationary thing. One thing you can't easily manufacture more of is 3 acres of beachfront property in the Hamptons. That's very difficult, right? And if you look at the cost of a Palm Beach house, they're $100 million right now. Okay, so $100 million for a house on 2 acres or 3 acres in Palm Beach. Now ask yourself the question, why isn't that getting cheaper? That thing's going up a lot. So the problem, coming back to money, is fiat currencies aren't anchored in energy. When we were on the gold standard, theoretically, during the gold age, 1870 to 1914, if a dollar was convertible in a 20th ounce of gold, right, and you really pegged it hard to gold, then you're anchoring the currency into a hard asset. Now, gold isn't fixed in supply. The gold supply increases at 2% a year, 2 to 3% a year. So if you're on the gold standard, that means that the supply of money would be increasing at 2% a year, or otherwise doubling every 35 years. So money under the gold standard, perfectly executed, bleeds energy every 35 years. It's got a half-life of 35 years. But that creates stable prices, Tom, because the economy grows at 2 to 3% a year. So if the economy grows 3% a year, if the money loses 3% of its value a year, then everything kind of stays stable, right? The demand increases, the supply increases, right? That's a good situation. In that case, you can save your money, and 30 years from now, your money will be worth as much as it is today. Now, if it turns out that you're saving your money and the supply of money is increasing at 7% a year, then the money is cut in half every 10 years, right? And so that means in 30 years, the amount of money you have will be cut in half once, twice, 3 times. So you would have 12.5% of your wealth in 30 years saving money under the fiat standard, under a 7% regime. Now, 7% was about the rate that the U.S. was inflating the dollar supply. But in the developing world, in weaker countries, you would see them inflate the money supply about double that, 14%. So the half-life of their money is 5 years. The half-life of the dollar is 10 years. Most people don't even notice 10 years as half-life, except that anecdotally, if you asked anybody in the past 20 years, are you going to save your life savings in a checking account that earns 1 or 2% interest in dollars? They would tell you no. I know intuitively the cost of a college education is going to go up. The cost of a house is going to go up. I can't just save in dollars that generate 0% interest. So under the fiat standard, the money supply is expanding from 7 to 14% a year, depending on where you are, until we got to COVID. And in COVID, everything doubled. And so you started seeing a much more rapid collapse in the value of fiat currency. The US dollar expanded the money supply 15 to 20% a year. And so in the US, we expanded the money supply maybe 40%. And so US single family homes went up in price 40%.
Oh, God.
I think about the correlation. The price of a house is 40% higher than it was 24 months ago. The amount of money in dollars is 40% higher than 24 months ago. The number of houses are about the same. The number of people who want them about the same. Makes sense. Now, if you go to other countries, if you look at currencies outside the US in the past 12 months, right? The Chinese currency has weakened 7%, Australian's down 8%, the euro's down 15%, the won's down 15%, the pound's down 17%, South African rand's down 18%, Polish zlotys down 18%, and Japanese yen's down 24% in dollar terms. What's happening? They're printing more money, right? It's even a bigger issue for them. The Japanese have pegged the 10-year interest rate at 25 basis points. And the US 10-year interest rate, right, is more than 10x that. The Japanese central bank is printing infinite yen in order to buy every bond and keep the price of bonds much, much higher than they would otherwise be. So they're holding up the price of bonds by pumping yen in the economy. And the reason, as they do that, the yen crashes against the dollar. But of course, it's even crashing faster against scarce desirable assets. If you price a barrel of oil in dollars, it just got 24% more expensive in Japan.
Why would they do that?
Because they want to prop up asset prices. They have institutions that are holding bond portfolios of yen, and they have institutions holding stock portfolios. And if they stop printing yen to hold up the asset prices, those portfolios of assets will crash.
Saylor also highlights the weakening of other global currencies against the dollar, driven by similar monetary policies in those countries. He cites examples like the Japanese yen, which has lost 24% of its value against the dollar in just 12 months due to the Bank of Japan's aggressive bond buying program. These policies, aimed at propping up asset prices, are causing currencies to crash against both the dollar and scarce, desirable assets. Please like and subscribe my channel.